Thank you, Melissa, and it's great to finish in the last presentation with a real focus on numbers, the most important part of the day. So look, thanks and good afternoon everybody for coming along today. I wanted to look at and I wanted to talk about AGL. AGL in recent history has driven value by doing big stuff. Big stuff like demergers, major retail and generation acquisitions, developing large-scale renewables and organically building our retail business. And we still expect to drive value by doing big stuff, albeit where and how is evolving. We're going from an investment thesis for shareholders based upon our leverage to rising wholesale prices as a result of some of the big stuff that we've done in the past, to one that's more nuanced. We're moving towards an investment thesis that is about ensuring that we use our operating advantages and our strong financial position to continue to drive returns as the industry transitions and as we work with the community to curb rising prices. Our strategy over the past 2 to 3 years has been about recognising that transition, where possible getting ahead of it, and about turning that very transition into new opportunities to create value for shareholders. Capital allocation during such a transition must be disciplined. We have to make sure that we're both creating value for the long term while still protecting ongoing returns. Now, the exact scale of the opportunity to reinvest in our core business as this transition occurs has been hard to articulate because it's been clouded by policy uncertainty and, to some degree, immaturity of technology. At the same time, we've been analysing whether there might be opportunities to invest in new markets, but this process has not and may not ever yield opportunities that meet our risk and return expectations. Indeed, we've walked away from large acquisitions in Australia and from the prospect of entering adjacent sectors to energy. We've looked at ways of returning more capital to shareholders, upping our dividend payout ratio and buying back our own shares. But we know we can always do a better job of communicating about capital allocation. So I'm going to talk to you for the next 20 minutes or so about 3 things: how we're thinking about our current investment plans, the scale of potential investment opportunity that we see through to 2020, and the capital allocation framework and principles that we're applying. Any discussion about capital allocation should begin with a discussion of strategy. You're all familiar with AGL's strategic imperatives, which we framed first at last year's Investor Day in Sydney: prosper in a carbon-constrained future and build customer advocacy. The word imperatives is key. These are non-negotiable things that drive the long-term development of our industry and our business, whether we like it or not, and they are bigger than AGL. If you like, you can think about them in the context of UN Sustainable Development Goal number 7, affordable and clean energy. We also talk about 4 key objectives. These are long-term, but they're more flexible. They are the things that, subject to our ongoing scenario planning process, are the principal drivers of our strategic activity, and to which we look for opportunities to deploy capital. Of course, basic business hygiene factors such as safety, cost management and people development will always get funded too. But in a strategic sense, anything that we are directing resources toward should drive one of these objectives. This visual can also be helpful in framing the transition that's occurring, and which often gets drawn on whiteboards when we're meeting with prospective shareholders. It shows our asset base today, including PPAs which are off balance sheet. While this asset base has moved away almost entirely from the upstream end of the energy sector in recent years, coal-fired generation assets have underpinned our strength today and will continue to be extremely important to AGL for years to come. Having said that, when the value of PPAs is considered alongside our direct renewable generation investment, the chart shows that renewable assets actually exceed coal-fired and gas assets, a trend that will only increase as we invest in the transition of the national electricity market. Now, this light blue wave shows very conceptually what the future asset base could look like. I cannot stress enough that this wave is not to scale, it's just conceptual. It will require some redeployment of the wealth generated by our existing business into new energy supply, storage, systems and customer experiences. And that is exactly what our current CapEx plans are about. No one is sure exactly how risk and return will look in the energy business models of the future some decades out. But our approach to capital allocation as we progress in that direction is about taking the next best steps of least regret to protect shareholder returns on the way. The consideration of new growth opportunities has to factor into that process, as does the potential to reduce the capital base by returning excess cash to shareholders. So with that introduction, let me provide an update on how our current investment programs link to our strategic objectives and how they are driving value. I'll start with our objective to move from mass retailing to personalised retailing. Our current focus in this area is the Customer Experience Transformation Program, which Melissa has just discussed. It comprises a $300 million investment completing in FY19. At present, no specific further investment programs are under direct consideration, but of course it is a key area for continued innovation as we seek to build customer advocacy over time. Because this program is about systems transformation, it requires substantial upfront investment, but as we've just been talking about, we expect it to be delivering returns above hurdle rates from FY20. Our second objective then, moving from being an operator of large assets to an orchestrator of large and small assets, is mostly about new energy and provides a great case study of our agile capital approach. The biggest area of investment in the past 2 years has been building up the ActiveStream digital metering business. As you'll be aware, we divested that business for a healthy profit last month. We pivoted away from owning the meter as it became clear that the importance of that ownership would be less than we had once thought. New energy is all about making appropriate bets in new technologies that can be scaled up or exited as and when a clear path or opportunity or larger opportunity arises. In addition to the new energy services business within customer markets, which is mostly a solar installations business, we continue to see a $50 to $100 million annual run rate of investment in new energy as realistic. We see ongoing investment in pilot projects, such as the virtual power plant, and in ventures and investments globally that give us more exposure to potentially disruptive startup technologies. It's one area that we know we will end up winning some and losing some, but net is vital to the long-term sustainability of our business. I'm going to spend a little more time on the next objective, moving from high to lower emissions technologies. It's the area that we have the most potential opportunity to invest, but also one for which final investment decisions and long-term returns are subject to uncertainty, political intervention, particularly political intervention, and global energy economics. So let's start with the PAF, which by any measure has been a great success for AGL. Proof that we can drive the industry to get the big stuff done, even when we are not directly funding it. The data is presented here includes the upfront development costs of our solar projects, which were sold into PAF, as well as AGL's equity commitment to the program. The outlook for further PAF-style investment is good. The cost of renewables, particularly solar, continues to fall, and the National Energy Guarantee provides the prospect of some investment policy stability, while still allowing state-based renewable targets to continue. Consensus seems to suggest large-scale build of renewables will continue, with gas peakers providing firming in the short to medium term, ahead of storage solutions becoming more economic. On that front, pumped hydro and batteries are very interesting, but unlikely to present immediate capital investment opportunities. Batteries, we believe, will come down considerably in cost, potentially triggering regulation to recognise the value of the instantaneous supply that they bring. Sites are available for pumped hydro, but we need to undertake further feasibility studies to assess potential returns. Long-term investment scope for the sector is not just big, it's potentially colossal, as I set out in a presentation in May. But the reality is that this looks like it is unlikely to affect our capital allocation decisions in the short term, and that even then may be infrastructure-like in deployment. Next shown on the slide is the Barker Inlet Power Station, which Richard has covered in some detail and is on track to begin construction in coming months for operation early in the 2019 calendar year. The impact then of our New South Wales generation plan is also shown here, including the approved Bayswater upgrade from FY19, followed by the New South Wales gas peaker subject to FID. The Crib Point LNG import jetty, if we go ahead, would primarily be an FY19 and FY20 capex requirement, totalling about $250 million, assuming AGL were to fund the onshore work itself. It would, of course, entail significant ongoing lease commitments for components like the FSRU. Again, as Richard has set out, the drivers for investment continue to hold and show no real sign of disappearing. The Silver Springs storage expansion, were it to go ahead, would be of a similar scale of investment to Crib Point, but again, the best commercial outcome there may not require AGL's full funding or even long-term ownership of the asset. In summary, what we are seeing is the potential for policy certainty and demand for new supply to provide potential opportunities for AGL to deploy capital at a higher rate in coming years than we did in the last few. The fourth objective relates to new markets. This has been a very minor driver of investment to date. The combined CapEx and OpEx required to drive our expansion into WA through FY17 and FY18 has been about $30 million, and that effort, as Melissa touched on, is tracking well. We chose not to pursue a major acquisition opportunity in that state, and we have also considered and shelved the prospect of a significant expansion of our domestic platform serving energy customers into the telco or other essential home services sectors. New energy continues to present opportunities for investment overseas, as that is where the majority of energy tech startups or funds are located. To date, we have not found opportunities for further offshore investment at the appropriate level of risk and return after detailed review. We believe the hypothesis for AGL to take its energy platform into new markets overseas remains sound, and the basic parameters are unchanged. We're interested in developed countries with a good rule of law and cultural alignment to Australia, with deregulated or deregulating energy markets. We're interested in businesses that reflect our own position in the energy supply chain and align with our strategic imperatives. And we would only proceed if we see a genuine advantage, an opportunity to leverage our existing platforms and capabilities to create value for shareholders that they can't access themselves simply by investing directly in those target markets. But as it stands, the opportunity set appears to be more limited than we had previously hoped. This slide brings together the previous slides and includes sustaining CapEx to provide a complete picture of approved or advancing through feasibility CapEx planning. I won't dwell on it, but it points to a pathway of over $500 million a year of growth and transformation CapEx, even as we develop further opportunities. Included here, but not assigned to one of the four strategic objectives, is the $130 million we are investing in what we call P2 which is our ERP upgrade. The totals on this slide reconcile to what we published at the FY17 result, adding in new initiatives such as the New South Wales generation plan, and also incorporating non-CapEx equity investments in areas such as new energy. I will use the last few slides to provide for investors a clearer and more comprehensive summary of our capital allocation principles. First, we will seek to maintain our balance sheet strength, consistent with our Baa2 credit rating, and to enable optimal response to opportunities as they emerge. Second is our dividend policy, We will seek to maintain our target payout ratio of 75% of annual underlying profit after tax, with a minimum franking of 80%. Third is what we have previously defined as our agile capital approach, to drive improved returns on equity over time in a rapidly evolving business environment. Agile capital, as Andy touched on earlier, has three pillars: optionality, quantum, and time to value. Optionality means maintaining and maximising our ability to pivot or exit objectives as objectives evolve, exactly as we did with Active Stream. Quantum means deploying AGL's capital only to the level required to achieve our objectives, just as we have done with PAF and we may do with other potential energy supply projects. Time to value means requiring returns within an appropriately short time frame, given the rapidly evolving environment. The fourth capital allocation principle relates to our continued application of our threshold hurdle rate. This is supported by ongoing analysis of our cash flows, our cost of capital, and the appropriate risk adjustment for competing investment classes. This is especially relevant in the context of my opening remarks. It is not just about driving returns from large transactions, but about managing a range of opportunities, some familiar and some less so, and which may differ substantially in their nature. Fifth and finally, we will return excess cash to shareholders if more accretive opportunities are not identified within a reasonable time frame. This slide speaks to the first of these principles in a little more detail. The chart to the left shows our strong funding capacity as at 30 June 2017 relative to our credit rating. AGL's internal modelling requires funds from operations to net debt of between 22 and 29% to maintain that credit rating. That translated to headroom of up to $2.4 billion at the end of FY17, a year in which we increased our dividend payout ratio and bought back almost $500 million of shares. We expect this position to be at least as strong at the end of FY18, even after taking into account that somewhat larger CapEx for this year. The chart to the right is our debt maturity profile right now. This financial year to date, we've removed about $280 million of unused bank debt facilities and bought back $70 million of bonds. We have no refinancing to consider until our $600 million hybrid becomes callable in June 2019. So as we think about capital allocation over coming years, we have considerable flexibility to self-fund growth, to retire debt, and to leave open other forms of capital management for shareholders. My penultimate slide updates our discussion of growth and transformation investment opportunities for the New South Wales Generation Plan and emphasises the level of advancement and likelihood of the potential overseas investment. The slide is pretty self-explanatory, but simply put, the dark blue at the top is stuff we're already doing, and that has a clear path to meet our hurdle rates. The lighter blue in the middle is stuff that feels quite possible, but is subject to pending feasibility studies and investment decision. And the pale blue fading to grey at the bottom is stuff at an earlier stage of development, or in the case of offshore, not feeling that likely to occur at scale. I remind you that other things such as entry into adjacent data-driven services like broadband have been on this list and have been rejected, reflecting a continuous search for and evolution of opportunities. To summarise, what does an investment in AGL mean today in terms of capital allocation and returns? It all starts with delivering against our strategic imperatives. Clearly, as Andy has discussed earlier this afternoon, the present day is all about managing key uncertainties, largely regulatory, but also technological, affecting our ability to invest with confidence in our existing business. We are also focused on exploring the potential risks and opportunities associated with other expansion opportunities, which we will only pursue where a truly compelling picture of shareholder value creation emerges. Medium term, we can categorise these into three potential buckets of capital allocation as investing in new products and markets, investing in the existing business, and returning excess capital to shareholders. As I've presented, there is more certainty emerging relating to the investment in the existing business and some visibility of the likely recurring scope of that investment. And we will continue to demand a higher rate of return to things that are less certain or less familiar, which may mean we may not do these things at all. If opportunities do not arise, we are in a very strong position to drive returns via capital management. Combined, this approach should continue to drive strong outcomes for shareholders, including improved return on equity over time. This emphasis on improved returns is embedded in our long-term incentive plan, which targets increasing return on equity from last year's 10.3% to a range of 11.5% to 14% in FY20. And we will continue to target our dividend payout ratio at 75% of underlying profit after tax. In summary, our CapEx plans reflect a broad spectrum of investment opportunities. Our capital allocation principles are governing our approach to investment and capital management, and we continue to target improved return on equity and a 75% dividend payout ratio. Thank you for your time today and for your ongoing interest and support. You'll also find in the supplementary information a guidance slide exactly restated as it was at the FY17 result and the AGM and unchanged. The ongoing support of our investors is essential to our licence to operate and a priority of which we will not lose sight. Thank you, and happy to take on questions.
Thanks, Brad. My question relates, I'm Sean Juru. I'm a bond investor from Vanguard. So my question relates to slide 51.
I'm trying to remember the slide numbers.
Yeah, so it's to do with your hybrids.
Cool.
So part one, what are your thoughts regarding the hybrid that is due to call in 2019, whether you want to move it up or down the capital structure?
Yep.
And secondly, your issuance diversification, what are your thoughts around issuing in other markets, diversifying your issuance? I know there isn't much need for that immediately, but what are your thoughts around issuing in the US and 144A market?
Yep. So firstly on the hybrid, I think it was an instrument that had its place at a place and time a few years ago and is somewhat dated in today's markets. The benefits of it, which were particularly about dealing to some of your credit metrics, have changed since we issued that hybrid. I think it's unlikely, but never say never, that we would go on to increase or issue another hybrid like it. Never say never, because everything may have its place again. In terms of reducing it, that'll be a decision as we get closer to June 2019, which is our first opportunity to call that instrument. On diversity of funding, clearly in an environment where we've been spinning off quite a bit of cash and we haven't been spending as much in the last couple of years, so our debt book has been reducing. What we've been doing is trying to make sure that we maintain diversity of funding. We did things like the bond issue up in Asia last year that went very well. We continue to look at other markets around the world. We have no fixed view as to which is the best market to tap. We want to stay open to all markets while still maintaining good relationships with our banking group, so that when the time comes that perhaps an opportunity comes along for the business to invest more, to use up some of that headroom, we've got good active positions in a variety of debt markets around the world, or at least we're keeping good track of them, so that on the day, whatever makes the most sense, we'll push forward into it. So what I would not like to see is a shrink down to a couple of markets or a couple of providers of debt. I think that's a much riskier position to be in.
Thanks, Brett. There's been a lot of talk about the closure of Liddell and replacing the output with a variety of different technologies. Liddell at the moment is clearly a good source of profits for the company. As we roll forward, and whilst there's plans to replace the output with the new technologies, if we take the view that all of the growth goes ahead as you've outlined and it does hit your requisite rate of return, how confident are you that the earnings coming through from this new set of growth initiatives will offset the Liddell closure?
Yeah. We haven't published a detailed view of will one replace the other in an exact amount in earnings. I think it's reasonable to say the New South Wales generation plan in isolation in comparing to Liddell, you have an asset that's fully written off, versus investing in new assets that will start to depreciate. It's hard to imagine that alone will be the offset in an earnings sense. That's why we're continuing to push forward and look for other ways to grow and other ways to improve earnings. So whether it's the push into new energy and new technologies, which are early days today, but in 5 years' time and beyond, we think we'll start to see those expand, whether it's testing other markets, whether it's thinking about new forms of large-scale things coming into our market like storage. All of these things are all about making sure that we're looking for good quality ways to reinvest so that as those future dips in our future start to come out, we've got other things that will replace them. So I think it's about looking more broadly than just the New South Wales generation plan for an exact dollar for dollar replacement. I think maybe Rob was first and then Andrew.
Thanks. Andrew began from Balance Equity. It actually ties into Nick's question, which is, I was just curious to get some comments on how you think your cost of capital is going to transition through that same period, given that, say, for example, explicitly to Nick's question, the earnings risk out of Liddell versus the earnings risk out of your, as you move from being sort of, I don't know, owner of the music hall to paid conductor.
Yes. Look, I think, and I don't know if everyone was picking up on it, but for me, when we put together these slides, one of the most interesting ones was that one with the wave and making the point that when you take into account the off-balance sheet PPAs we have, which in many ways you're on the hook in the same way as if you owned it directly, we have more in renewable generation right now than we do exposed to coal-fired assets. And so when I think about cost of capital, when we think about cost of capital and where we're heading, there's a fair blend of that future already there. And so we're 50-50 coal, gas, thermal and renewables. We'll see, coal's going down. Maybe we'll see some more gas-fired in a firming sense. There's no question we'll see more renewables coming into that mix. And so while we'll trend in that direction, I don't think you should look at Liddell and go, wow, there's a big step change there in the company portfolio. It's been subtle, but we've actually got a big exposure reflective of, for a very long time, we've been the biggest private developer of renewables. We've got a big exposure to renewables already, so there is a glide path inherent already in the way people view us and cost us.
Me? Yeah. Okay. Sorry, Brett. Rob from Morgan Stanley once again. So if I just a question about how we should be thinking about the franking balance and that level of franking. I guess you've still got tax losses at AGL Generation Holdco and quite a lot of IT spend, which I guess you depreciate reasonably quickly. So yep. We should probably be thinking at that 80 level for a fair while to come, or?
Yeah, I'd think about the 80% franking for a fair while to come. We thought long and hard before we both upped the dividend payout, so the cash payout it was tracking at 60-65% up to 75%. When we did that, we felt, in looking at our medium to longer term forecasting, we just couldn't hold the franking. And it wasn't a 1 year thing, it was a many year thing. Otherwise, it was only a 1 year thing. There are a variety of ways to bat through a 1 year dip. So I'd think about 80% for the foreseeable future. When you're forecasting, though, those Loy Yang tax losses particularly will come to an end at some point, and so that may be the point where you start to revisit, is there an opportunity to tune back up? If we have franking, we'll pass it on, obviously.
Just on new energy, you're putting 100 million in, you've put a bit of money in, probably a couple $100 million already in there. How are you getting your mind around getting a return out of this, and how are you actually justifying it? I appreciate you sort of need to make the investment for the future, but it's actually starting to build up to be a large amount of money over time.
Yep.
When do you turn around to Elizabeth and say, I want some cash back?
I do that every day. I think, and I'll let Elizabeth build on this as well, I think when you dig into the detail of how we're investing, it's a little bit like that agile capital thing that we were talking about. Quantum comes into it. So a $5 million investment in a piece of technology, it's quasi-OPEX. And so we don't overthink it in that sense. And we're more forgiving, if you like, in terms of will we see a return. What we want to see is capability development. The battery trial in South Australia is a case in point. At the other end of the spectrum, as we start to invest tens of millions and maybe 50 to 100 million, and there's been a couple lately like the commitment to the EIP fund, which is a venture fund based out of the States, that's one where we look at that with perhaps tougher eyes and say, no, we actually expect there to be a reasonable path to see money coming back. That's a good quality, well-run fund that believes that on balance it should deliver superior returns, even as we acknowledge the risk because it's in a technology sort of area. So horses for courses, and the bigger the investment, the tougher we'll be on saying when will we see our money back. But I'll let Elizabeth build on that.
Question. Hello. Thank you for your question, and thank you, Brett. That's exactly right. So we're looking at different time horizons to maintain the principles of agile capital. So optionality is a very important one. So some of the investments are smaller bets that we see perhaps maybe more futuristic, but yet crucial to overall strategy of the business. So for example, if you looked at the smart house and you saw the Sense technology, that is very, very fundamentally disruptive. It enables orchestration like we've talked about in the future. It really enables customer participation, us to have a very clear understanding of the actualities of the curves of the load shape within the house, and to think about that in terms of our hedge book and what Richard's trying to do with his business. So it's really powerful technology. They're a portfolio company of EIP. So what we are doing is we are leveraging that investment in EIP through then the piloting and being able to bring that technology here, which mitigates disruption risk for the company down the line. That has a smaller risk for us, but it's a longer time horizon. If you think of the slide that Melissa presented in terms of where the personalized retailer, where the retail business of AGL is going across different time horizons, we're looking at then getting returns across those different time horizons and sizing the bets accordingly. And thinking about some of the technology, for example, is not that new of technology, but it's being applied in different ways that create new business models. And so that's how we're thinking through this very thoughtfully, and also with a very aggressive, clear path to make sure that the strategy is aligned, and that also that the technology, as you see from everything we're talking about, this is not crazy stuff. It's not technology that is actually first generation. All the things we're talking about have been proven in another market, and they're actually in their second or third iteration of the actual technology maturity as it's being applied to energy. So IoT may be applied to other markets. They've had proof and use cases there, and now they're coming into application in energy. So that lowers our risk as well.
A couple of questions on the web chat, which are a little bit more linked to Richard's presentation, but might just go through those now. The first one related to, Richard, what your views were on pumped hydro in a 5-minute pricing environment. And the second one was, could you expand on why reciprocating engine technology is better than sort of classic OCGT?
Second one first. Start time. OCGTs are more efficient than reciprocating engines, so same megawatt hours, slightly less fuel burn than OCGT. It's not a massive step change in difference, but it is a reasonable change. But the start times. In a market with very high penetration of renewables, the ability to get generation on the bars and on the bars very quickly is exceedingly valuable. If we move to a 5-minute marketplace, well, we are moving to a 5-minute marketplace, that speed to get assets on, 2 10 minutes at $14,000 is a lot of money not to have generation running. So getting those jet generation on is absolutely critical. So reciprocating over OCGT is absolutely speed of response to marketplace. And OCGTs, although they're working on the technology to increase that speed, I'm sure Dave can answer some questions to the room about that, it's not anywhere near the same level of reciprocating engine. In terms of pumped hydro, hydro generation is not so much pumped hydro, it's actually hydro speed to market. How fast you can get the water through your turbines. Hydro works very, very fast. Now, it depends on all the different assets to their true response times, but they are fast return assets. The problem with hydros is not the actual technology itself. The technology is reasonably simple and well known and trusted. It's actually sites for hydro. You need a head level, so you've got a drop to create the generation, and you need places to store the water. They tend to be national parks, unfortunately, and people get very touchy about flooding national parks for some reason. So actually finding sites for hydro is critical, but they are good investments, and obviously AGL has hydro in its portfolio that can respond very quick to these marketplaces. I didn't put them up on the screen because they're very niche investment opportunities, so I was rather looking at the screen to look at what we would be investing going forward, recognising those assets are actually already incredibly flexible in responding to a 5-minute marketplace. So hopefully that answers the question.
All right. Well, I think we've exhausted questions on that topic. So happy to take any one-on-ones over a drink, and I'll hand off to Andy to wrap up.